Welcome to ValueVest Daily. As always, the analysis you are about to see is for educational purposes and is not financial or tax advice. Imagine waking up to find one of the market's most aggressive short sellers has just targeted a retail fintech darling. On March 17, 2026, Muddy Waters Research published a report claiming SoFi Technologies is an Enron-esque financial engineering treadmill rather than a genuine growth business. This chart shows the immediate market reaction. SoFi stock plunged 6.5%. It forces us to ask, does SoFi actually hold toxic debt, or did the market instantly reject a targeted attack? The most immediate counterforce to the short report didn't come from retail traders, but from SoFi's own leadership. This is SoFi CEO Anthony Noto. Right after the stock dipped, he stepped in and aggressively purchased 28,900 shares. He committed approximately $500,000 of his own capital at $17.72 per share. Following that insider buy, sentiment on platforms like StockTwits reversed violently from bearish panic to heavy bullishness, with message volume surging 181%. To understand if this reaction is justified, we need to deconstruct the exact math behind the Muddy Waters attack, examine SoFi's regulatory structure, and evaluate their underlying technology stack. Determining if SoFi is a legitimate 10x value play requires ignoring the daily emotional price swings and rigorously auditing these competing balance sheet narratives. First, we have to look at the mechanics of the attack. Institutional short sellers, investors who borrow shares and sell them, hoping to buy them back later at a lower price, often use a print and profit tactic to generate immediate returns. Muddy Waters explicitly disclosed their intent to cover most of their short position immediately after publishing the report. Their thesis centers on the claim that SoFi is using aggressive marks, meaning they are artificially inflating the estimated fair value of the loans they hold. The report draws a parallel between SoFi's fair value gain accounting and the historical collapse of GE Capital, suggesting the reported asset values are an illusion. They base this on a major discrepancy in loan charge-off rates. A charge-off occurs when a lender declares that a debt is unlikely to be collected and writes it off as a loss. Looking at this gauge, Muddy Waters calculates that SoFi's real hidden charge-off rate is approximately 6.1%. That figure stands in stark contrast to SoFi's officially reported charge-off rate of 2.89% under generally accepted accounting principles, or GAAP. The most severe accusation in the document, however, involves a potential material misstatement regarding unrecorded debt. Muddy Waters claims SoFi is utilizing off-balance sheet structures to hide at least $312 million in liabilities. This chart illustrates the mathematical consequence. Removing that $312 million debt block from the calculation could artificially inflate SoFi's adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, by up to 90%. The report alleges the motive for this financial engineering is relentless equity dilution, designed specifically to ensure management hits their bonus targets. If these specific mathematical claims hold up, the company's valuation is entirely fabricated. That math validates the initial panic and the steep intraday plunge. This is SoFi's corporate headquarters. The company issued a heavy pushback the very same day, labeling the short report factually inaccurate and stating it demonstrated a complete lack of understanding of their financials. SoFi's primary defense relies on their legal and structural classification as a bank holding company. Achieving and maintaining that classification requires rigorous ongoing vetting by the Federal Reserve, shown here. It also subjects them to an additional layer of intense regulatory scrutiny from the Office of the Comptroller of the Currency. Furthermore, as a publicly traded entity, the Securities and Exchange Commission mandates strict adherence to standard accounting practices for all their financial reporting. In this context, CEO Anthony Noto's stock purchase is a heavily regulated, legally binding declaration of financial health, carrying severe penalties if he knows the books are cooked. The oversight of the Federal Reserve, the Comptroller of the Currency, and the SEC creates a massive structural hurdle. For the short seller's hidden fraud thesis to be accurate, SoFi would have to be successfully deceiving all three federal agencies simultaneously. Moving past the balance sheet debate, we have to look at SoFi's actual operations. They have transitioned from a pure student loan provider into a diversified digital bank. They achieve this by integrating external APIs, application programming interfaces that allow different software systems to communicate, to drive high-margin, non-lending revenue. As seen here with their MasterCard partnership, SoFi integrates directly with global payment networks to scale their operations quickly. They are also diversifying into modern financial infrastructure, like stablecoin settlements, which generate revenue with much lower capital intensity than traditional lending. This diagram shows their technological feedback loop. A digital-first platform captures vast amounts of user behavior data, feeding it into a credit risk engine that outputs their controlled 2.89% default rate, which then optimizes new user acquisition. This continuous, algorithmic refinement of their credit models theoretically insulates their loan up against defaults, even in a high interest rate environment. Currently, the stock is trading at roughly 46 times forward earnings, a valuation that bakes in a significant amount of market fear. The math for a 10x value play requires the stock to scale from its current $17 level into the $30 to $50 range and continue compounding from there over the long term. That multi-bagger upside depends entirely on their digital architecture successfully lowering customer acquisition costs while scaling those high-margin revenue streams. This underlying technology ecosystem provides a structural floor for the stock, separating SoFi's growth potential from the heavy physical overhead vulnerabilities of a traditional legacy bank. We must rigorously address the downside vectors. High interest rates mechanically squeeze margins and pressure all forms of consumer lending. Broader macroeconomic factors, including recessionary fears and global geopolitical friction, threaten loan quality across the entire banking sector. Furthermore, as this fracturing stone illustrates, the short report presents a binary risk. If regulators prove even a fraction of the $312 million hidden debt allegation is true, the core investment thesis collapses under the pressure. Conversely, the specific market mechanics currently surrounding the stock could trigger an explosive upside rally known as a short squeeze. This formula shows the variables converging right now: high short interest, explosive retail trading volume, and heavy insider conviction combined to create massive upward price pressure. Because Muddy Waters stated their intent to rapidly cover their position, a major layer of structural selling pressure is already being removed from the market. The combination of trapped short sellers scrambling to exit and unyielding insider conviction creates a highly asymmetric, coiled spring dynamic for the stock price. The March 17th crash and immediate recovery serves as a textbook example of market dislocation driven by institutional hit-and-run tactics. The choice for investors is clear. You are either betting on an unregulated short seller's theory of hidden debt, or you are trusting the audited financials of a heavily regulated digital bank. As this clearing horizon shows, if SoFi's GAAP accounting holds true, the noise of the short report will inevitably fade. For patient investors, this allows the underlying business fundamentals to dictate the long-term price. If you want to build out your analytical framework before deploying capital, make sure to subscribe, like, and share ValueVest Daily. Drop a comment below with the specific high-risk, high-reward opportunities you want us to analyze next. True asymmetric value investing requires doing the rigorous math exactly when the rest of the market is panicking. Stay analytical